Monetary policy is turning more data-dependent just as artificial intelligence spending explodes and equity leadership broadens beyond a few mega-caps. That mix is forcing investors to rethink both earnings durability and risk premia across the equity complex. You are watching vTalkInsight, Equity Pulse Daily for July 1st, 2026. The macro backdrop for equities is defined by a tug-of-war between stubbornly hawkish expectations and growing signs that inflation is easing. Markets are still pricing roughly a 2 in 3 chance of another Federal Reserve hike by September, and some forecasters talk about as many as 3 moves this year. At the same time, forward-looking inflation indicators, including wages and productivity, point toward price gains drifting closer to the Federal Reserve's 2% goal, while market-based break-evens have fallen sharply. Against that backdrop, the institutional framework around policy is getting more attention. Recent Supreme Court rulings have effectively reinforced the independence of the Federal Reserve by making it harder for any president to remove governors, which reduces the risk of overt political interference in rate decisions. In contrast, another decision that allows presidents to fire heads of independent agencies more easily could inject regulatory volatility in other areas, complicating long-term corporate planning even as monetary policy itself looks more insulated. In Europe, the European Central Bank has moved firmly to a meeting-by-meeting, data-dependent stance, avoiding forward guidance and stressing that its last hike was a direct response to sustained oil strength rather than an insurance move. Declines in energy prices in recent months support a pause case, but officials still refuse to rule out another increase. In the bond market, expectations for the United States 10-year yield are now clustered in a range around just above 4 to roughly 4.5%, consistent with 1 or 2 additional hikes already embedded in prices. Currency markets add another layer of complexity. A strong dollar, underpinned by that hawkish Federal Reserve profile, has pushed the Japanese yen to its weakest level against the dollar since the mid-1980s. Japanese officials are talking tough, but have not yet signaled imminent, aggressive intervention, keeping volatility in Asia elevated and pressuring equity markets, such as Korea, where overseas investors have been net sellers. Looking ahead, the United States Treasury market faces a structural jump in supply toward $50 trillion over the coming decade, while more of that duration risk is migrating from banks to leveraged non-bank investors, which could amplify stress in the next risk-off episode even as upcoming central clearing reforms aim to improve resilience. Equity markets are entering the second half from a position of notable strength. The S&P 500 has just logged its strongest quarter since 2020, with total returns in the mid-teens to high teens, despite a wobble earlier in June. Tech and, in particular, semiconductor stocks delivered their best quarter on record, even as volatility stayed in the high teens. Over the past week, the index has shaken off several down days to rally into quarter end, while the VIX has slipped back toward the mid-teens, signaling renewed risk appetite. The advance remains heavily influenced by technology, but leadership is slowly broadening. Semiconductors and other AI beneficiaries still dominate performance tables, yet emerging markets, small caps, and value-oriented shares have started to outperform growth year-to-date. Healthcare, which had been lagging badly, has narrowed its underperformance versus the S&P 500 by about 10 percentage points in a single month, helped by a record pace of biotech mergers and acquisitions. Defense stocks in Europe are also outperforming on the back of rising missile orders and drone demand, adding another non-tech leg to the rally. Flows reinforce that equity-friendly tone. United States exchange-traded fund activity is running roughly 60% above last year, and June saw record investment-grade corporate issuance, much of it from large technology firms financing AI initiatives, with credit spreads still stable. Retail investors have been buying equity dips at record scale, particularly in semiconductor names and broad market ETFs. Positioning remains skewed toward the United States and AI-related sectors, but forward price-to-earnings multiples sit around the 40th percentile historically, which means the valuation debate now hinges less on starting multiples and more on how durable current earnings expectations prove to be. Consensus profit forecasts for the S&P 500 still imply room for a sizable further rally if numbers are met, with a significant share of that optimism tied to ongoing AI diffusion through 2026. Importantly, earnings growth for the non-tech parts of the index is expected to catch up and potentially overtake tech in the second half, which, if delivered, would help widen market breadth. However, concentration remains a key risk. NVIDIA's outsized gains and the dominance of a handful of mega-cap AI names, along with extreme concentration in markets such as South Korea, where SK Hynix and Samsung account for more than half of index weight, leave indices vulnerable if sentiment toward this narrow leadership group falters. The AI investment cycle is the single most important structural force in equity markets today. Hyperscaler technology firms are embarking on a multi-trillion-dollar infrastructure build-out, with projections of roughly $5.3 to $5.5 trillion of AI-focused capital expenditure by 2030 and updated forecasts pointing to around $1.2 trillion by 2028 alone, already well above prior consensus. These plans are backed by a reported $2 trillion combined backlog and by record corporate bond issuance, particularly from large technology groups tapping investment-grade markets to fund data centers and networking. This spending is powering one of the strongest semiconductor upcycles in history. NVIDIA's rally has been central to S&P 500 performance, while memory and storage leaders have posted gains approaching 100% year-to-date. SK Hynix, which controls a majority of the high-bandwidth memory market, is preparing a major Nasdaq listing to reduce its valuation discount versus Micron and capture more of the AI-themed capital. Upstream, equipment makers such as KLA and ASML are rallying as South Korean and other Asian chip manufacturers outline investment plans totaling roughly $500 billion, signaling confidence that AI demand will stay robust. The boom extends well beyond chips. Data center real estate investment trusts, including Digital Realty Trust, are seen as key beneficiaries, with expectations that proceeds from deals, such as asset sales involving Blackstone, will be recycled into larger hyperscale projects. At the same time, local opposition and permitting delays in regions like Northern Virginia highlight physical and political bottlenecks to unbounded capacity growth. Commodity markets are also being pulled into the AI story, with copper and other industrial metals increasingly viewed as strategic inputs for power-hungry infrastructure, reinforcing tightness in selected parts of the materials complex. There are, however, mounting risks around this AI supercycle. Financing is increasingly debt-heavy, with corporate issuance on track for a record year and global debt to GDP near 100%. AI-related demand for memory, chips, and components is contributing to sticky inflation, complicating the Federal Reserve's path toward eventual rate cuts and supporting the case for higher for longer policy. On the micro side, value is slowly shifting from AI models toward proprietary data and integration. Microsoft's move to diversify its AI model suppliers, including lower-cost open-source options, points to margin pressure for pure-play model providers such as OpenAI and Anthropic, while the IMF flags AI-enabled cyber attacks as a growing risk to financial stability. Outside the AI complex, several sector-specific signals flesh out the broader equity picture. In financials, analyst downgrades of Goldman Sachs and Morgan Stanley, along with a more cautious stance from Oppenheimer on big banks, reflect concern about leverage, earnings volatility, and the potential for another negative cycle in the sector. At the same time, over half of institutional allocators reportedly plan to increase hedge fund exposure, and managers such as Ares, Blackstone, and KKR are being favored over traditional banks, underscoring an ongoing shift of credit creation and risk-taking toward alternative platforms. The consumer backdrop remains nuanced. United States job openings have been revised higher to around 7.5 million, and hiring is strongest in relatively defensive areas such as education and healthcare, while early signs of expansion are emerging in more cyclical sectors like transport and wholesale trade. Yet consumer confidence has slipped, and lower-income households are feeling acute pressure from non-discretionary inflation. Nike captures that split. The company beat on revenue and earnings, with earnings per share jumping to 72 cents versus 14 cents a year ago, while gross margins held around 39% and inventories ticked up only marginally. However, Greater China revenue fell 12%, Management faces at least a year of work to repair brand perception there, and the strategic pivot back toward wholesale plus ongoing job cuts, including in technology roles tied to early AI initiatives, show a franchise still in transition. Transport and energy transition themes are also generating important signals. Waymo's decision to end its partnership with Uber in Phoenix and push a direct-to-consumer strategy comes just as Uber commits to buying tens of thousands of electric vehicles from Lucid and Rivian, moving away from an asset-light model and raising its capital intensity at a time when its shares are down more than 20% over the past year. In contrast, defense and clean energy stories are more straightforwardly supportive. AeroVironment and other drone-focused names are rallying as governments lift defense budgets and prioritize counter-drone capabilities, while solar companies such as Enphase and SolarEdge are surging on talk of potential United States bans on certain Chinese imports, which would tighten supply and favor domestic manufacturers. Pulling this together, the equity market is balancing a powerful AI-driven earnings and Capex story against a stickier rate backdrop, elevated currency and policy uncertainty, and pockets of sector stress. Disinflation indicators and reinforced Federal Reserve independence argue against extreme policy tail risks, but markets still price further hikes and very delayed cuts, keeping the cost of capital firmly in view. At the index level, the S&P 500 enters the new quarter after its strongest run since 2020, with semiconductors, data centers, defense, healthcare, and select consumer names all contributing alongside the core AI complex. The key questions now are whether non-tech earnings can deliver the catch-up that consensus expects, whether AI Capex can continue at its current pace without sparking more overt bubble dynamics, and how far regulatory and geopolitical frictions spread into key supply chains. Into the next data prints and earnings season, watch the evolution of labor and inflation numbers, hyperscaler spending guidance, breadth across the S&P 493, and any signs of strain in bank funding or leveraged non-bank credit. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.